know these companies like the back of your hand. Make sure
Right.
you know everything about them so that when it falls 20% after an earnings report, you know exactly why and you can calmly gauge whether that's compelling and whether that's something to be taken advantage of or whether it's something to be avoided because there's a very healthy mixture of that in fundamental investing. That's the thing about fundamental investing. There's this annoying nuance for every single company that you really have to know and understand. And then again, accept the fact that you're never going to know and understand all of it. And there's always going to be a company racing 80% higher that you don't own and vice
Yep.
versa. It's laying the foundation, it's laying the plumbing, the architecture, whatever you want to call it, so that your product creates a ton of value and then obsessively ensuring that it creates more and more and more value over time. And that's the cause and the effect is high profit growth. The stomach is the most important thing for making money in the stock market. And
Yep.
that is hurting your probability of being disciplined and staying the course and overcoming the noise after you've already done all of the work to know that what matters, what's important is going well for the company. Because I think learning financial statements and learning how to read financial statements and understanding Fed cycles and cost of money are just two of the most important things that we can do for building financial health and for building prosperity. You should not be trying to fit a square hole in a round peg. You should be doing what speaks to you.
All right, welcome back, everybody, to the TraderLion podcast. I'm your host, Richard Moglen. This is brought to you by the Ultimate Trading Guide. You can pick up your resource down below. Joining us today is someone who I've really wanted to talk to for quite some time, Brad Freeman. He's an investor, the founder of Stock Market Nerd. Many of you guys, I'm sure, are familiar with him. And this is going to be a really great conversation, diving deeper into the fundamental researching a company side of things, which can really complement and help you build conviction in ideas that you're already focused on trading. So, first of all, Brad, thanks so much for being here. How's everything going?
It's going well. My setup is not quite as nice as yours. I've got the glare in the background and some toddlers whining in the other room, but I've been told the sound is not picking it up, so crisis averted, and really excited to do this.
We're here to steal your knowledge. So if you can provide that, that's going to be great. So, Brad, this is going to be really great because I always like talking to people with different perspectives. As a swing trader, I like talking to day traders, and I like to talk to people on your side of the spectrum, which is more investing, and to hear kind of your process and how you view everything. But to kind of set the stage, how did you first get interested in the markets? Where did that kind of love for investing kind of come from? Was there anybody who kind of helped you along the way? A family member? Did you learn about it in school? Yeah, bring us back to the very beginning.
Yeah. So I think at this point, I've built maybe I'd call it a healthy process that's going to keep being refined all the time. But at the beginning, I wouldn't like in hindsight, I thought I was a genius back then, but I wouldn't. I would call it being born into the industry in more of like a gambling mindset and not a super responsible way. So undergrad 2019, 2020 in grad school and pandemic happens and they tell you to go home and I was working at a registered investment advisor while I was doing my grad program. They did not know how to give remote work. So I was very bored, and sports were on all the time, or sports weren't on all the time, but markets were open all the time.
Right.
So I was like, oh, I can just bet on this. And I think when I talk to a lot of friends, there's a lot of that, especially with how legal sports gambling is now. It's just a natural, not natural, maybe a somewhat slippery and dangerous kind of branch out from sports gambling from 9 a.m. to 4 p.m. when there's nothing on. So really
Right.
not the healthiest way of doing it. And just and in terms of people who kind of fixed me, because I did need fixing, it was my dad and being a great role model and essentially saying, you seem passionate about this. I was working at the RIA. I was writing for Motley Fool, so I was very busy doing a lot of work, but I wasn't using this work in a responsible way at all.
Right.
And I was like indulging the dopamine hit and wanting the dopamine hit in me and all those good things. And he said bluntly, very bluntly, like you can do this, but you need to recycle what you're doing right now and create a sustainable way of making this a career that's not going to blow you up every 3 months. Which he was very right. And I'm very happy that I had so little money at that time. But then 2020 kind of happens and start to learn, start to do a lot more writing and just start to listen and form a process. And I spent about 4 years of doing that before I charged anything for my work. Just really wanting to be a sponge, wanting to. I mean, I think we're on the same age. I might be a little older than you, but I was 23 at the time. And so and like you, we didn't spend 15, 20 years climbing our way up Wall Street and working at funds and all these things. Like we went out and did our own thing very quickly because that's what kind of spoke to us. And so for me, it was a matter of going very slowly, and listening to good people, having good people in my ear, and just very, very carefully rebuilding a process from the ground up that I was confident could be something that was sustainable and replicable and durable across cycles, which so far so good. But I mean, it's again, I mean, Buffett's been outperforming for 40 years. So when I get to that point, I'll start pounding my chest. But I'm not there yet, obviously. Not close, but a few years in, and things are going well. And I expect them to keep getting better and better because I expect to keep getting better and better.
Yeah, and that mindset of a system's never a finished product. We're always polishing, we're always learning, regardless if you're a trader or an investor, that's the key to like you said, sustainability over many market cycles. We're not in this for a few years. We're trying to do this for decades sustainably, grow our accounts, so we can improve our lives. So I love how you put that. In terms of the process that you built, obviously you mentioned your dad. Um, what were kind of your major influences that have helped inform you about how you go about investing, finding ideas, researching them, building positions? Were there any kind of main learning sources that you could really point to as having a really big impact?
So I mean, for you guys, it's Bill O'Neill and Stan Weinstein are like the
Yep.
two goats for lack of a better sophisticated term. And I think within my growth and fundamental framework, it's Peter Lynch. And I mean, I learned a ton from Buffett and Munger, and I know that that's what everyone in my field is supposed to say, but I really I gravitate to Peter Lynch and how his mindset of just know these companies like the back of your hand. Make sure
Right.
you know everything about them so that when it falls 20% after an earnings report, you know exactly why, and you can calmly gauge whether that's compelling and whether that's something to be taken advantage of or whether it's something to be avoided because
Right.
there's a very healthy mixture of that in fundamental investing. And it always looks the same. Stock just went from $80 to $60. It looks cheaper, but our estimate's about to come down a lot. Did they just lose market share in that quarter and they're showing signs of maybe losing market share again? Did they say macro is really bad and their competition said macro is really good? So, well, maybe that means you're doing really poorly. So just all these really fine details that I kind of collect and glean and aggregate for all of my readers, just to kind of to kind of separate the ideas of stock and company for again for my approach and for you guys that just doesn't work and it's just the matter of one size is never going to fit all but making sure that from a financial statement point of view our margins trending in the right direction is growth trending in the right direction how healthy is the balance sheet are you going to have to raise cash and dilute me again in a month so it's things like that market share trends even more subjective key performance indicators like an NPS score or Net Promoter Score, which is
Yep.
usually internally derived, but still a really good way of showing how maybe not the absolute number because again it is internally derived, but that trend showing how much better you're taking care of customers than you did a quarter
How
ago. As
sticky
long
your business is. Yeah,
yeah, as long as methodology is not changing, then that trend actually becomes very informative. But it's collecting all the public information that we have available because we can know everything as public investors. We can know everything that we're legally allowed to know. It's just a matter of us being motivated enough to go chase that information. And for me, that's really where the edge comes from, where um, I can be really calm when Meta falls 30% and everyone thinks, well, oh, they're right back to spending irrationally and a stock's going to go right back to $80. But if you listen to the transcript and what Zuckerberg is saying, he's still saying we're going to do this while still delivering operating leverage from an explosive base. So that's very nitty gritty, but maybe gives an example of how stocks get punished for a lot of reasons, and sometimes those reasons are compelling and sometimes they're not.
for sure. And so you mentioned Peter Lynch. His book, One Up on Wall Street. Were there any really key takeaways that you gleaned from that? Favorite quotes, favorite ideas, if you can't remember a favorite quote as well, that you think kind of really represents your style and how you approach things.
Yeah, my favorite Peter Lynch quote of all time is everyone has the brain to make money in stocks and not everyone has the stomach. So really, I mean, we throw around all these acronyms and jargon and it's all arithmetic. Financial statements are all addition and subtraction and multiplication and division, and everyone listening to this podcast right now has the ability to do it. It really is just um, again training your mind to feel to react the right way to certain things. So
Right.
of reacting the right way to a company like Progeny that I own that was a total absolute loser. That's just talking about how there's these utilization trends in fertility treatment, which is biological. So there shouldn't be anomalies every single quarter of something happening because human nature is not evolving on a whim every 3 months and in different ways. And there's these anomalies that are peaking up every single quarter. So things like that. But then there are those other meta examples. So it's really just on a case by case basis, evaluating all the data in a very calm, cool, and collected manner, and then deciding if Mr. Market is being rational or irrational and presenting you with an opportunity. And then obviously, sometimes accepting the fact that we're going to be wrong because no one's going to bat 1,000 and no one's going to be perfect. But I love that quote. And another idea in that book that's so central to everything he does is just, again, knowing what you own, but in a sense of taking advantage of your surroundings and your community. So I have 5 or 6 Starbucks around my area. There's 3 or 4 Lululemon stores. I can go and drive by every Saturday at 11 a.m. before I watch Michigan football lose another game and see how busy their stores are and see how busy that is compared to last week. And we have to be careful there because that can get a bit anecdotal. But if you're hearing things like Lululemon is dying and
Yeah.
no young people are wearing that clothing anymore, and you're driving past those 4 stores and in affluent areas but different towns, and you're seeing a zoo of 14-year-old girls and boys that are ripping through clothing trying to, that was a really creepy way of putting it, but who are purchasing clothing from
Interested in it. Yeah.
Lululemon and
Yeah.
trying and spending their money there and clearly telling you that they're voting with their wallet and this brand is fine. Well, maybe that can give you just slightly more confidence that these sensationalistic stores are empty. They're all done. Maybe is a bit overblown.
Yeah, by the way, William O'Neill, who obviously is one of our big inspirations for our style, he would go to parking lots and see traffic and all that. So, I think he as well is of that same mind, Peter Lynch.
I love
You
that.
know, learning the story and deep story that gives you that conviction, and all of that. Um,
Hard to
and by
do
the
with a company like CrowdStrike, but easy to do with a company like Lululemon.
Exactly, exactly.
Yeah,
And actually, a lot of the companies that he made the most money on were more tangible, and you would want to be able to understand the story and all that. Now we've got these software companies that who knows what they do. To be honest, you got to dive deeper. And by the way, along the lines of what you said about listening to your community, seeing what's around you, I should have listened to my girlfriend on Elf last year when I asked her about it, and it's gone up so much since then. But I want to bring you back to your beginning a little bit more and ask, were there any really key mistakes that you made early on that, could be a warning lesson to newer investors out there, that maybe you can give them words of caution, things that you would, if you were starting now, you would really try to avoid, versus how you
yeah.
acted then?
I'll do 2 mistakes. There are way more mistakes than two, but but I'll stick to two. Teladoc was the first one. So a 2021 pandemic darling pull forward, and they're growing 80% a year, and me assuming that's structural and not taking into account the fact that we just had a once in a lifetime or 10 lifetime pandemic, and maybe digital telemedicine is going to be a little more popular during that time. But it wasn't even that. It was them spending like $20 billion or something like that on Livongo at like a 40 or 50x sales multiple. And then just kind of they combine 3 or 4 point solutions and try to talk about how that data is creating a lot of personalization and how all this personalization is going to create a mode that Amazon can't match, and then Amazon matched it in 5 minutes. So the lesson there is that every CEO and CFO thinks their business is defensible. Every CEO and CFO thinks they have an edge over the competition, that they're going to continue to succeed. And keep in mind, they own a lot of stock, so they have an incentive to tell you that they're going to do really well. But I guess using not common sense sounds a bit arrogant, but just do these arguments make sense? Does it make sense that Teladoc has data on 4 medical point solutions and Amazon with 100 million Amazon Prime subscribers and the ability to buy whatever healthcare data they could possibly need? Can they really not match that personalization? And what is personalization? It's data and algorithms. Does Amazon not have data? Yes, they do. Does Amazon not have Bedrock with a world-class suite of LLMs that they can use? Yes, they do. So um, competitive edge is very important. Your margin is my opportunity, as the great Jeff Bezos always
Yep.
said. Her perfect quote for the Amazon example. But it was believing management teams because they're supposed to be believed, because obviously they're telling the truth, and it's not that they're lying. It's that um, they're biased. They're extremely subjective, and we have to understand that when they're telling us everything. When CrowdStrike is saying, yeah, we're a Ferrari and Sentinel-1's a Fiero. Like, okay, I get that you think that, and Sentinel-1 thinks the exact same thing about you. So, just thinking through those things. But with Upstart, I think this was a matter of learning about macroeconomics and respecting how absolutely vital and important those cycles are
Yep.
to everything that we do. When a company is originating subprime credit, sure, maybe they have a better algorithm that can underwrite a little better. I think that remains to be seen. But it doesn't really matter if you're originating subprime credit and rate hikes are happening rapidly and inflation is going through the roof and capital market supply and liquidity is dried up, you're going to suffer mightily. And again, a CEO and a CFO with no capital market experience saying we're immune to macro cycles and we're just going to keep growing through it, no problem at all. You hear those things, and as someone going through their first cycle, like I was at 4 years ago or 3 years ago, wherever it was, you think, okay, they're probably right. They probably know something. And no, they were not right. And no, they probably don't know something. And when rational common sense tells you that subprime credit's going to get blown the heck up whenever the economy turns sour again, listen to that. Go with your gut, trust your stomach, like Peter Lynch so famously said. Because if it really doesn't make any sense to you at all, there's a good chance it just doesn't make any sense. So
Perfect. And to set the stage even a little bit more to where we're going now, which is, your process and all of that, from a very high level, what are you trying to do as an investor? What's kind of your goals? And how do you kind of describe your overall investing style?
yeah. So the newsletter business, I think there's two goals for what I do, and it's split by personal financial goals and taking care of readers and subscriber goals. So taking care of readers and subscriber goals, I think the best way of explaining what I do is just spark notes for all the important information that comes across markets, investor days, earnings calls, all those things. Read and spark notes did, if that's a verb, but down to something that's 5-10 minutes to read and has all the implications for you, has my opinions with explanations, and then kind of invites you to go make your own decision. So I'm never trying to say you need to go buy this right now. I'm telling you, I added to this today or 2 minutes ago, and this is exactly why I did it. And do what you want to do. So it's empowering them with information, arming them with the ability to make an informed decision in a very small fraction of the time. But then the other part of that is I use a lot of this research myself. And I use like it's obviously what I use to build my entire portfolio. So my goal is to outperform the S&P 500 over a 10, 20, 30-year period. That's what I want to do, fully knowing that there are going to be periods of underperformance. There are going to be periods of outperformance because while I do try to manage a portfolio in a very cautious and slow manner. It is higher beta. There are more growth names in there. The anchors are Amazon and Meta, so it's not like a UNH and a Johnson and Johnson atop of portfolio. So there are going to be bigger upswings, there are going to be bigger downswings, and it's going back to that Peter Lynch idea of trust your research, trust that you know what you're doing, that the ideas of financial statements and valuation didn't change overnight, and that when a stock is not cooperating and the company continues to cooperate, that's just to offer some symbolism, just a coiling spring of future returns. And that's really how I view it. And that's really it's that view that's allowed me to take advantage of really explosive upside, especially 2 years ago and recently. And yeah, I think I'll leave that there.
Yeah, perfect. And what I really want to focus today is your research process because that's your bread and butter. So first, how do you find stocks that you want to start researching that are worth and compelling enough to for you to start diving deeper into the story? What's kind of the top of the funnel? How do you first find these different ideas?
Yeah. I think there are two. Well, Twitter is so great for not for getting great ideas that are refined and complete, but for getting inspiration where you can
Right.
kind of run with it on your own.
The
And
spark to build the spark notes.
yeah. So I ask questions on Twitter every 3 or 4 weeks, like what's your largest holding or what are you adding to most aggressively? And for me, selfishly, that's a list of 400 or 500 tickers where, well, I haven't heard of that one. Let's go to FinChat and see how things look. And if things look good enough, well, maybe we should cover an earnings report or two, and see how those look and dig a little deeper. And maybe if that's still really compelling, maybe it's time to retroactively go back and read 8 earnings reports and the S1 or I'm sorry, the IPO prospectus, and listen to or read investor day transcripts, all these investor conferences where they they will go to JP Morgan or Bank of America and tell you how things are going mid-quarter, and they always repeat everything except there's always one little golden nugget in there that's brand new, that makes me listen to 30-minute interviews 30 times a week during that Goldman conference in September. But it's really I'm kind of running on a rampage. I don't even remember what the question was that you asked.
Yeah, how do you first find ideas? So yeah, like you
Right, right,
mentioned
right, right,
Twitter
right.
and diving deeper. Yeah,
Yeah. So that's one branch. And the other branch is sometimes these financial statements look really ugly. And sometimes there are great reasons that they look really ugly. And sometimes those reasons are creating a disconnect between sentiment and forward valuation and what these companies can actually do in the future. I think PayPal is a great example of that. Changing accounting methodology so that they're now counting stock-based compensation as a non-GAAP expense. So non-GAAP expense growth now looks really bad. And so no earnings growth, no, well, that they just got it to transaction margin growth, which for them is very important. But it's things like that where there was an accounting change, or Mercado Libre has just been absolutely like not blown up, but the Argentinian peso has been a massive headwind for them, and everyone else relying on revenue there. For Uber, it was a business that generates revenue in over 100 countries, is literally a 2 point foreign exchange headwind from that country alone last quarter. So there are always reasons that things can look very bad temporarily. There are very few reasons that things are going to look bad for a long time. But that's another area where Twitter comes in handy, where people where I'll call out like some ticker and say this looks really ugly, this doesn't look great, and they'll say, they usually say you don't know what you're talking about, but sometimes they'll tell me why I don't know what I'm talking about and actually offer a valuable constructive opinion of like AppLovin, which was one that I missed. I own Trade Desk. It's one of my largest holdings, one of the best companies I've ever invested in, and ad tech is something I spend a lot of time on, and still didn't invest in AppLovin. And it's because when you look at forward sell side estimates for 3 or 4 years, it's like this company's trading at what was trading at 50 or 60 times forward EBITDA and expecting like 10%, 15% EBITDA growth. But that was just a matter of sell side estimates had not remotely caught up to reality, and the fact that their core business was growing so strongly and becoming such a bigger part of their overall business. So there's just that's the thing about fundamental investing. There's this annoying nuance for every single company that you really have to know and understand, and then again, accept the fact that you're never going to know and understand all of it, and there's always going to be a company racing 80% higher that you don't own, and vice
yep.
versa. Yeah.
And when you first say you hear a company and you dive a little bit deeper into it, what are, 1 to 3 things that you might see that really get you excited and say, all right, I really have to take notice of this company and dive a lot deeper.
Yeah, I love companies that don't have to work very hard to grow. So Duolingo, I think, is a phenomenal example. I think over 90% of their growth comes from organic word of mouth. And they call it organic marketing, which can include social media marketing. So I shouldn't call it word of mouth. But they most of almost all of their growth, it comes completely independently from any sales and marketing dollars that they're spending. They spend all of their money in a more efficient way than anyone else, split testing obsessively their product so that was this light shade of green more engaging, or was this slightly darker shade of green more engaging for the owl in this screen on this class, like
Right.
to that level of picking up a hundredth of a basis point of engagement gains from doing that. That's what they're focused on all day long, just making sure the product is always getting better based on having the largest set of learners in language learning in the world, and using all of that data to create a more engaging experience. So you look at all of their other competitors, 2U and Coursera and Babbel, and their business, their growth engines are completely funded by marketing. So that's fine, but they're never going to find any kind of durable growth. They're never going to find operating leverage where they can stop spending so aggressively and still have that revenue. And they're never going to be able to put it on autopilot and continue to deliver top line expansion. Duolingo is. They've demonstrated that they can continue to shrink sales and marketing dollars year over year all the time, and keep growing. DraftKings, which is another great example of that, just slashing marketing spend every single quarter, taking market share, growing revenue rapidly. So these companies where there's just this, and this is very intangible. It's branding, and it's branding, and it's creating a fantastic product that motivates people to go spread the word for you for free.
Yeah.
And that's what creates that really easy growth. And what that means on financial statements is that profit growth is going to be far in excess of revenue growth because margins are going to go higher and you're going to make a whole lot more money. So it's laying the foundation, it's laying the plumbing, the architecture, whatever you want to call it, so that your product creates a ton of value, and then obsessively ensuring that it creates more and more and more value over time. And that's the cause, and the effect is high profit growth.
Perfect. And are there any kind of one or other two things that when you first hear a company, all right, I really have to dive deeper into this, or was that kind of the main one from your perspective?
That's one that really encompasses every sector,
Right.
and just I mean when you go to a SoFi, there's way like the things to learn are way different. Like a bank balance sheet, it doesn't even resemble a CrowdStrike balance sheet,
Right.
and a third of the analysis on SoFi is capital ratios and liquidity and capital market access solely for the balance sheet, and then for CrowdStrike, it's like cash, convertible notes, that share count done. Like you can spend that's why people love software as a service companies because the balance sheets are so unbelievably easy to understand and read. But I do think, regardless of what sector you're looking at, that is very important to pay attention to. Just marrying the cash flow statement and the balance sheet so you can see, because the cash flow statement kind of represents how much is being added to that balance sheet on a quarterly basis.
Yep.
And then the balance sheet tells you what does the stock of, not stock of stock price, but like stock of cash, stock of debt, all those kind of things. They offer you a balance of all those items. And really, I mean, if you're seeing things like they have 100 million in cash on their balance sheet, they're burning $80 million a quarter, um, and there's no sign of them inflecting positively to cash flow. That means there's going to be a much larger share count or much more debt in the future. And that's
Right.
just going to get into shareholder returns when they eventually do turn profitable because you're sharing profits with a larger pie, more mouths to feed. So balance sheet dyshygiene can really erode returns. Really relying on expense growth again to fund every part of it really can erode returns. And then I want to just you asked for three, so I want to just maybe
You don't
throw
have
in
to give three
one.
if there's not one that really comes to mind, but if you've got one, shoot.
Yeah, and I think it's again, so just like Net Promoter Score, this one is a bit subjective because there's so many different ways of calculating it, but it really goes back to giving you a number for how hard are you working for this growth, because some companies are externally do rely on external marketing.
Right.
Like Hims is one that does really well. I don't own that, but they've done phenomenally well with generating really strong returns on marketing, strong marketing payback periods. Lemonade is another one that's done phenomenally well with that, where they are relying on external marketing, but they're sort of making it work. And where you can kind of see that show up is lifetime value to customer acquisition cost, so LTV to CAC. And again, it's really annoying. I wish this was a gap metric so that we would have kind of a uniform way of calculating it. But some companies will say, okay, total gross profit over a lifetime of a customer, and some will say total operating income, and some will say total net income. So it's calculated differently. But again, just like NPS, it's that trend. We want to see that moving
Right.
higher. We want to see that the economies of scale are kicking in, and while you are marketing funded, you're spending the same amount of money to generate more and more revenue. And we'll see that show up in like an LTV to CAC, which anything above 2x is really good. But moving from 2 to 3 or 3 to 4, there were some companies are in the SPAC bubble in 2021. Well, I think it was Matterport or something, calling it an 8x LTV to CAC. And that was like peak mania. Like when you saw that, you should have folded it up. And I mean, obviously, I need a time machine so that I could have understood that. But yeah, subjective way of counting it, and another one where don't focus on the number, focus on the trend.
Perfect. And to flip that question on its head, what are some key red flags? I'm sure you've got a whole list of them, but maybe the top three that, if you start looking to a company, you see that, you're like, all right, no, I got to move on to something else. This isn't even worth looking further into.
Yeah. One accounting thing is if they're just constantly changing disclosures because they want to keep making you stop look at the things you should look at and look somewhere else. Changing disclosure sometimes when the business model changes. I think like for Palo Alto, they went from billings to remaining performance obligations, and they did billings is like invoices that you can send, and remaining performance obligations is deferred revenue and backlog. So it really encompasses multi-year everything that you have booked for the future. And they
Right.
really switched to a multi-year framework of platformization deals, or really just trying to sign much larger cross-sell deals, and offering more deferred revenue, offering longer terms at more favorable prices. So that really does make billings less important, and it makes RPO more important. But when that's happening constantly, and I don't have an example off the top of my head, it's probably a bit shady for lack of a better term.
Yeah.
Also, when companies are seeing like their core business just in permanent decline and want to, this was another one, Progeny really annoyed me, but talking about how well they're cross-selling new products that aren't moving the financial needle at all. The Gen AI wave is another good example of this, of people trying to create hype and excitement about my Gen AI products are creating real value, but they're just not making any money. And you look at some other software companies and they are making a lot of money on Gen AI. So you think to yourself, well, I know like app layer monetization comes after foundational layer monetization, but these guys are already figuring it out. So why aren't you?
Right.
So dangling carrots when the elephant in the room is very ugly and needs to be addressed. Those two things, and then it's just general themes like heavy cash burn that isn't improving, egregious stock-based compensation practices that are only getting worse, revenue declines, permanent margin contraction, which shows that you have no pricing power and are having to find revenue by consistently charging less and less, like an Intel sort of. So it, it's 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 again that idea of creating great products that motivate people to want to buy them and want to tell other people to buy them takes care of
Right.
all of this. And if you're not doing that, then all of these things these will all be byproducts, and it will be a leaking bucket that you're constantly plugging. And instead of focusing on building, you'll be focused on maintaining. So
And specifically about the leadership team and the CEO, is there anything you really like to look for, or again, things that, would turn you off from, wanting to
yeah,
invest in the company?
yeah. I think charisma turns a lot of people off. It doesn't really turn me off, to be honest. But charisma must be the more charismatic you are, the better I mean, you have if you talk a big game, you have to walk a big game. Like Jeff Greed at the trade desk talks crap about Google all the time, and that means you're going to get a lot of crap if you don't absolutely flawlessly execute every single quarter. CrowdStrike the same thing that they talk about SentinelOne and Microsoft like their inferior competition. And that means that when you have an outage in July of 2024,
Yeah.
oh, you think we suck? Well, well, time for us to tell all of your clients how much you suck, so that we can steal all of them. Which to CrowdStrike credit, they did a great job of addressing that. But it's uh, yeah, those are definitely it's it goes back to the fundamental nuance, and I know that
Yep.
word's going to be super annoying to a lot of people because there's no uniform. He's this charismatic, X plus Y equals too charismatic and avoid. Like it's like just results backed up by that talk, and it doesn't bother me very much. But then aside from that, track record I think is extremely important. So
Right.
if again like a company like Upstart, which congratulations to shareholders, has done well lately. I do remain skeptical, and we'll see how they do over the coming quarters, but. Um, Stocks going higher is good for the newsletter business. So I hope I stay wrong and they keep making more money. But the leadership team did not have any capital market experience. They all came from Google. And they tried to tell us how they were smarter than capital market pundits and how they could survive while everyone else flailed, and they could overcome all of this. And the headwinds were just too strong for anyone to overcome. But I want a lot of relevant experience and I want a lot of relevant success. So
Right.
um, like company like again going back to Lemonade, which is just very speculative and has turned into to more of a successful story over the last few weeks. But when they do things like hire away USAA's chief claims officer in a parallel role, like a horizontal hire going from USAA to Lemonade, you think to yourself, what? Like, why did you just leave your USA job to go to this billion-dollar insurance disruptor who's trying to compete with you, the elephant, with the fortress value proposition for military communities that no one is ever going to touch or come remotely close to touching, but you left for Lemonade. So what does that really mean? So leadership can kind of offer signal. When you have CFOs, a CFO suite that's a revolving door, that is a red flag.
For sure.
When you have a team like SMCI, Supermicro, that was gotten a lot of trouble for accounting fraud 5 and 6 years ago and didn't replace anyone and now is reporting amazing numbers with the exact same leadership team. Maybe maybe there's something going on there again. But hindsight 2020. But yeah, leadership matters a ton. I think business model matters less than the team, or product matters even less than the team, and who's in charge of steering that process and augmenting it with other add-ons and all those things. Because just looking at a company like SoFi, you are a bank. I mean, sure, you own your tech stack, and when bears all come to me and say it's a bank, I look at them and I say, yeah, you're right. It's a bank. It's a bank that has durable cost advantages in terms of having a charter and being able to match that legacy cost advantage. And then it doesn't own any branches, and it owns its own tech stack, which are more unique cost advantages, which in a commodity is pretty durable. But it's a bank, and I think we've gotten here despite the fact that it had a 3-year student loan moratorium, which heading in was its largest product, because it has a phenomenal CEO who pivoted and bobbed and weaved and made sure and demanded from his team that they continue to deliver structural growth through one of the hardest periods to do that for banks in a very, very long time. So the what's the saying? Like, bet on the jockey, not the horse, or I'm probably flipping that or something.
Yeah,
But
yeah,
I think that's super important. Leadership matters so much. I mean, you can have a company like PayPal and Dan Schulman inherit just a gem of a company all those years ago and run it into the ground. And then you can have someone like Alex Chris come in and run it back out of the ground in 6 months.
right.
So team matters so much.
Yeah, perfect. I'm learning so much because so much of this is just not my expertise. So this is excellent.
Well,
Um,
we learn from each other, man. I
yeah,
learned so much from you too.
awesome. Um, in terms of the companies that you personally like to invest in, are there particular themes or business models that you like to go for? And I also wanted to hear what if there's a specific size of company that you like to focus on, whether it's a small cap, big cap, or
Yeah.
that's kind of agnostic to your process.
Yeah, in terms of size, that doesn't I own Amazon and I own Lemonade, so kind of opposite ends of the spectrum. But in terms of the general themes of what I look for, the one that structural growth at a reasonable price is always hard to find and very appealing to me. But it's rare. I think structural grower is almost as overused of a term as moat, because structural growth is extremely rare, and generally there are cyclical factors propping up or holding back growth to some degree. But that matters a lot. I also love profit inflectors. Companies that are going from they've been losing money for 6 years and then all of a sudden they're going to make a lot of money, because
Right.
generally analysts are very, very hesitant to stick their necks out and say this inflection is going to be more explosive than everyone else thinks it is. And they're generally pretty darn cautious in terms of assuming how explosive it's going to be. So as this inflection starts to play out, you generally get very explosive upward revisions of profit estimates, which are something that stocks absolutely love and always will love. It means margin contract. It means multiple contraction. It means better risk reward. It means obviously more profitable companies. All these wonderful things. But the other thing that margin inflectors mean, that is another reason why I love Peter Lynch, and I'll explain that in a second, is they trade at 1,000 times earnings, because okay, you're earning a penny and you trade at $10 a share. So yeah, you're trading at 1,000 times earnings. I mean, and someone will go to Yahoo Finance and see 1,000 PE and say, that's absolutely ridiculous. I'm never going to buy that. No way. But they don't know that you're going to go from earning a penny this year to earning 50 cents next year. So you're going to
Right.
go from 1,000 times earnings to 20 times earnings, if I can do math on off the top of my head. But would I say $10 stock? I'm pretty sure I did. But if I didn't, I'm sorry. But basically, that creates a lot of inefficiency, in a lot of positive surprise for these companies to enjoy. And the other thing is as companies inflect profitability, that's them proving out their models, and with a very important milestone of showing you that they can generate enough on the top line in a more in an efficient way to start generating shareholder returns, which is at the end of the day what we all care about. So it's this disconnect of 1,000 times earnings. Screw that, that's expensive. I'm not doing any more work on it. That creates opportunity, and how to, I guess, package that opportunity into more metrics, because we love metrics. We love metrics. Is Peter Lynch's PEG ratio framework. So that's price to earnings ratio divided by earnings growth. So what that can do is say, okay, you're trading at 1,000 times earnings, but if you're going to go from 1 to 50 in a year at 50x growth, that then or let me give a more tangible example. So let's say you're trading at 100 times earnings, and earnings are going to grow at 100% year over year for the next 2 years. Then 100 times earnings, which sounds very expensive, trades at a 1x peg. So 100 divided by 100. And the general rule of thumb with always much more context and annoying nuance needed is that 1x above that, it starts to get more expensive, and below that it is cheap. And for me, for the types of names that I look at and in our world of lower interest rates and more liquidity and all those things, I think 1.1 or 1.2x is probably a better way of thinking of it today, than when that book was written all those years ago. But I and why and so two more pieces of context there. He uses net income pegs. And he'll use 1 year of earnings growth. I love using 2 or 3 years of earnings growth, again, just because it gets back to that structural grower.
Right.
We want, if they're growing 50% 1 year and 0% the next year and 0% the next year, I don't want to credit them for 50% earnings growth. I want to credit them for whatever that CAGR is over 3 years.
Right.
And then sometimes there's no net income, or sometimes there are things like, not no net income, but things like weird changes in tax rates, or like large tax benefits 1 quarter that make profit growth look insanely amazing, where it becomes important to start using operating income, or EBIT, earnings before interest and tax, for this. So there's variations of the peg that I do use openly, but the framework is his. So thank you, Peter Lynch.
Yep, perfect. No, it's always great to have these legends that we can build off of and spin off and tweak and build our own processes from, but we've got that foundation. Um, when you've got a company that you're interested in, how do you go about building a position? I know there's probably a lot of nuance here, but do you start with a certain amount of your portfolio, watch them over, a set number of quarters, continuously add if they keep performing, meeting expectations? What's kind of that starter size, and how do you go about building a position overall if it's a completely new idea for you?
Yeah, I would say there's two answers to that, and it depends on, are you profitable or are you not profitable? So, not profitable, more speculative, higher beta. Full position is probably going to be 4%, and it's going to start at 2, and slowly ramp over time, accepting the risk that I might not have an opportunity to ramp, like with a Starbucks. Brian Nickel was hired as CEO, and and it went 30% higher, and multiples stretched, and I've had to sit on a smaller position than I wanted to and just haven't been touching it. But I think that discipline is very important, because risk reward always matters, and sometimes risk reward isn't compelling enough to add. But for a company like that, it's kind of like a 2 and 4 rule. And then for a company like, let's say, like Amazon, for example, if I had decided tomorrow that I wanted to start a new position, that's more of like basically like take 2 and 4 and multiply it by 1.5. But the most, so four, yeah. So yeah. I'm sorry, did that make sense?
So
Like
around
like three
three,
and
four
six,
percent.
yeah.
Yeah, yeah. Gotcha.
Three and
Okay.
I'm sorry, that was a really stupid way of saying it. I should
No,
have
no,
just
I understood you. I need just to be clear for everybody.
see, we all like to sound smart. I'm literally yeah, it's dumb, but we're not smart. We just like to sound smart. But 6% is about as much as I'll invest into a company on its own, on my own. But I will absolutely let it grow much larger than that on its own.
Yeah,
That's something that I've had to get a little bit better at. You watch a company that you own for 2 years do absolutely nothing, and then it races higher over a short period of time, and you want to start selling immediately. It's like, dude, just let yourself be right. Let yourself be right. And I think that's something that I've had to do. I've had to kind of retrain my mind over the last very short period of time, just because 2022 is fresh on everyone's mind. I think
yeah,
still, especially the long-term investors who had similar portfolios back then to what they do now. That PTSD is very fresh on our minds. We have to respect that and avoid getting greedy and complacent. And I think when 40 times sales becomes a normal part of the conversation again, that will be a telltale sign to, this is unsustainable. But at the same time, we're gearing up for more rate cuts. This, like, inflation isn't at 8%, it's below 3% now. The unemployment rate's still firmly in full employment territory. So all these really giant macro fears that led to a lot of needed multiple contraction delivered that multiple contraction. And now we're seeing all these more reasonable valuations, maybe outside of Mag 7, which is dragging up the index level valuation. But we're seeing all these companies that have proven their models are real through one of the hardest times to do so, that are now
right.
trading at cheaper multiples. So let's let them get rewarded. And I am always gonna. Whenever I see something like up 200% in a month, I'm gonna take some profit off the table, and I'm gonna just reduce risk a little bit just because I have to. But yeah, it's a weird balance right now of 2 years ago was one of the sharpest, well, probably the sharpest correction. I don't have it off the top of my head since the Great Financial Crisis. I would think, or at least the pandemic, and those are probably pretty similar. I think it was a 30% drawdown or something like that. But that don't fight the Fed. And now don't fight the Fed means own stocks. It doesn't mean
Right.
sell stocks. So
And that was actually going to be my follow-up question, which you just touched on, but it'd be great to hear a little bit more color on, you know, if you own a position that's doing well, what would lead you to trim your position, by how much, and is there any kind of things that could happen that, all right, I got to sell all of this, the earnings
yeah.
report completely changed my perspective on
Yeah.
things. I have to sell my position.
So I'll give the listeners a comped portfolio update from last week. But I sold I think I've sold like 30% of Lemonade during this recent run. I've sold a lot less of SoFi, which I also own, and I think that those two examples are really good to put side by side.
Hmm.
Lemonade has not seen much upward profit estimate revision. I think that's going to come. I think sell-siders are catching up, but also just for context, a gross profit market multiple is around 10x. It's gone from 6x to about 18x in in a very, very short period of time. And so it's gone from a deep discount to markets to a large premium to markets. I think it earns some of that premium. I think it probably trades closer to 14 or 15x, not 18x, because again, estimates have to come up. But it's still swung from a large discount to a large premium. And when that happens, risk reward always worsens. And when risk reward always worsens, especially when there's people telling you how stupid you are for selling and how it's going to double again in a week. That risk reward always deteriorates when multiples expand. So that regardless of how excited I am about this company and their investor day was a very strong showing,
Hmm.
regardless of me being more comfortable with this being a larger position than I've been in 3 years, like 2 years. But it got way more expensive, so it's time to take a little bit off the table, and hopefully it gets less expensive over time, and I can add more. So it's that is a bit of a swing trader, I think, trait in me of I'm reacting not to price charts, but to valuation charts. And if the multiple is expanding a ton, I am lightening up most likely. And with SoFi. Stocks raced higher, but estimates have also raced higher. For a company like Uber, that's gone from $20 a share to $80 a share. That's because free cash flow and net income estimates exponentially expanded because the company was so much more profitable than everyone thought. So the stock's going up, but it's not getting more expensive, and the risk reward isn't deteriorating. So I think I spend way more time looking at PE charts and price to EBIT charts and price to gross profit charts than price charts. And that's really why.
No, that's so interesting. And I want to get into the fintech space in general because I know you've done a lot of research on
Sure.
this, and that's recently been a huge theme. Like you mentioned, Lemonade moving up, SoFi moving up, Square has been moving up again. What's your take on what's driving this move right now, and how are you kind of viewing things in general?
Yeah, I think we're all geniuses and no other context is needed. No, I think it's rate cuts, man. It's the Fed. It is accommodative macro policy for the first time in years.
Hmm.
And for these companies, lower cost of capital means lower hurdle rates or lower profit spread rates to clear for capital market pundits that are buying up loans so that they don't have to stash them on their balance sheet. It means inherently higher profit spreads for these companies, which means they'll be riskier and more aggressive in buying up these loans. It means faster velocity of money. So for these really important debit interchange businesses, they get a large boost. It means people are searching Bitcoin a million times a second right now, and Google Trends are going through the roof, which is good for brokerage account interest and creating there. For a company like SoFi, that has a software branch to them where they're trying to sell large B2B deals. It shrinks sales cycle and makes people more emboldened with their budgets, which helps close deals more quickly there.
Right.
So rate cuts just for this sector, they are immensely important. And I know some of these are banks. So you hear rate cuts, that's supposed to be bad for these companies. And it is for because it weighs on net interest margin, all else equal. But for all these companies, they've been able to basically toggle their cost of capital with deposits with this federal funds movement to offset that while having all these tailwinds in place that are making them more profitable, and also while allowing themselves through things like we don't have 1,000 branches all over the United States with bank tellers who we have to pay, allowing that to mean they're willing to absorb some of this NIM hit and make them even more compelling to compete against JP Morgan or Bank of America, which I mean, not to talk my own book, but I just moved all my money from Bank of America to SoFi, I think like 8 months ago or something like that. And the amount of money that I've made having that sitting in a savings account with SoFi instead of Bank of America is ridiculous. I mean, it would have been irrational to keep my money anywhere else. Uh, that so the yield chasing that's happening is more companies that don't have all of these fixed costs inherently built into their models can more rationally preserve this,
Right.
while other companies like Bank of America and JP Morgan weren't even trying to preserve it when rates were higher. So deepening their edge in terms of leading with yield, because within a commodity, you do have to pay me more to attract me. I mean, a UI is great, but at the end of the day, who's paying me more yield? Who has a slick interface and is paying me more yield? I'll go with that one.
Right.
But going back to debit interchange and sales cycle elongation, and credit aggression, all those things benefit mightily from rate cuts. And over the last 2 years, well, we were all called absolute morons for holding these companies and calling them coiling springs and saying that it really wasn't a matter of all these businesses are losers and their CEOs don't know anything and they all suck. It's that we just had one of the most historically aggressive rate hike cycles in a very, very long time. And that's a massive headwind for all of these companies
Mhm.
as they entered this rate hike cycle, trading at multiples that made no sense. So they all got blown the heck up. And I think now we're kind of reevaluating, going back to the idea of they weathered this storm. They proved that they were real. Times are about to get a whole lot more fun. Profit growth is going to be a lot faster. Multiples are going to be a lot higher. Sentiment's going to be a lot better. And I think it's that perfect storm of, man, stuff sucked for a long time, and now it's all getting better in harmony, where you have macro and micro tailwinds blowing in harmony. It's pretty compelling, I think. And that has played out a lot over the last 2 months, which is again why I've lightened up on some of these names already.
Do you think it will be a longer term trend, or like you said, you kind of lined up a little bit, but what was your thoughts on the durability of that trend?
I really do think it's based on path of rate cycle. And I don't think we need more cuts for these businesses to do well, but we need to avoid, and I think this is a low likelihood of actually happening. So I don't want people to think that I'm saying this is going to happen. We need to avoid a sharp spike in reinflation and having to address that by raising rates aggressively. That's what
Mhm.
we need to avoid for the quality companies that are creating value, that are offering shareholders and stakeholders something that others can't. That's what they need to continue performing. They either need more accommodation or stability. They don't need more accommodation. One of those two things. But I think if you see a Fed funds rate hiked 8 times again over the next 12 months because inflation spiked back higher, these companies are not going to do well.
Right. And a little related, but obviously it's a fintech company, but Coinbase. I'd love to hear your thoughts on that. What do you think about the business in general, the themes it's following? Yeah, I'd love to just kind of hear your thoughts on Coin.
Yeah, that's one where um, maybe I'm not as like optimistic and excited about it as others, just because I do think they are a brokerage at the end of the day. And I
Mhm.
do think that while regulation from a new administration, which is speculation right now, might be really good, it also might be really good for product parity from all their other customers and or from all
Mhm.
their other competitors to kind
Right.
of create a more even playing field for them. But in terms of the Coinbase business, I think they've done a really good job of standing up that subscription and service arm of the revenue base, and not being so entirely reliant on transaction revenue, which for crypto is just, it's always going to be crazy volatile. But that is a company for me that I put in a too hard pile, because it really depends on crypto excitement, and it depends on frenzy and volatility and things that I have a very hard time modeling and a very hard time quantifying, and timing up to a point where it's just like I'm gonna report earnings and avoid this. But what I will say is that they've done a very good job of creating products that attract institutional investors that are less prone to coming in and out every 5 seconds like a retail investor. They have done a good job standing up that subscription and service business, which is more recurring than transaction revenue. But you still get these absolute, and they also have done a very good job of right sizing their cost base so that they're EBITDA positive regardless of what market environment they find themselves in. Of shedding enough cost to be able to guarantee that. But I don't know. I don't see. so I don't see something in this model where you're like, yeah, they can do that for the next 10 years and no one else is going to be able to replicate that for a lower price. And brokerages really are a race to zero on cost and fee. So yeah, I don't, it's not my favorite.
Yeah, I would say, and I don't have a Coinbase account, I don't have any stock or whatever, but I think they do have a little bit of that intangible word of mouth that we talked about earlier, where if
Absolutely.
you know if your friend is like, "Hey, I'm interested in crypto," you're like, "Do you have a Coinbase account?" Or if they have a Coinbase account, you're like, "Hey, that should be the spot
Yeah.
to buy coins." So I think there's a little bit of that.
Yeah. And I think
Next, yeah, go ahead,
and
please.
two more pieces of credit for them. They have a beautiful, beautiful balance sheet. So much cash, which is why I don't even know one like FTX and what were the other ones that blew up? I mean, so many of their
Yeah,
competitors blew up over the last 2 years, and they're fine. So that is
right.
something that you have to look at and say, really good, really good. So yeah,
Yeah. Um, Next, Tesla. That's the question. What are your thoughts there? It's been from our perspective consolidating for 2 years now, really since its 2020, 2021 run. Now it's just gotten interesting again from a price trend perspective, but I'd love to hear your thoughts on the fundamental side. Is there anything really that's different? What are you seeing going out to the future? What trends are they taking advantage of? Yeah, what are kind of your general
yeah.
thoughts on that?
So tough year or 2 years for them. Through all of that, I think it's important to say that while they've seen a lot of margin contraction in the auto business, that EV program they have is still leaps and bounds more profitable than any other EV program in the United States by a mile and a half.
Right.
Which is why they've been able to do things. You've seen things maybe punished a little bit on the sentiment side, like free financing or price cuts or things like that. They're what they say, which actually does make some sense to me, just as an innocent bystander, is that they're willing to accept a lower upfront cost on the car, knowing they'll still have some margin, and then to harvest more margin over time with software cross sells, like full self driving, robo taxi, things like that. So they're counting on more profit to be collected down the road. But Tesla again is you could throw it right in that fintech conversation, not in terms of that's what it does, but in terms of higher rates mean higher cost of capital, mean more expensive cars. And the opposite is true when rates go down. So macro has sucked for the entire sector for a while, and now it's about to get a lot more fun. Um, I mean, just to avoid, I guess we'll say the fact that or to mention the fact that Elon probably is gonna have a good relationship with the person leading our country in a few months. I mean, that's just a fact, which is probably a good thing for their business. And then along those lines, a faster roadmap, slashing red tape to get to a federal framework for autonomous vehicle legalization, I think is better for them than anyone else. Just because Waymo and Zoox, which is what Amazon owns, and they're trying to stand up, they're going city by city, and they're basically mapping mapping urban areas. They're not doing what Tesla would call full self-driving in terms of just general self-driving can go pick you up and take you to a national city tour throughout the United States and go to chargers and then go to California. Like they're not doing that. But a federal framework for legalization where now this county line, the two counties bordering it have the exact same policies. You no longer have to get up to that line and get out of your car and get in something else because laws tell you you can't be in that.
Right.
So I think Tesla, how many years until they pull that off? If we listened to Elon 15 years ago, it would have been done 10 years ago. But he will tell you openly that he's always going to give these timelines, and they're probably always going to be wrong because he's always overly ambitious. He will say that to you. He knows that. So when does this happen? I don't know, but this expediting of the process by putting this in the hands potentially of the federal government is good for Tesla, and I think is bad for everyone else that they're competing with. From a financial perspective, I think a lot of this excitement's been baked in over the last few weeks. The stock has been soaring higher. Um, it's again one where you'll have people you can talk to Jim Chanos and he'll tell you how it's going to fall 90% tomorrow, and then you can talk to the whole Mars guy and he'll tell you how it's going to 10x tomorrow. So I mean
Yep.
the amount of excitement on both sides of that name is sharp and intense and palpable. But you do kind of see a scenario where they should be able to sell cars a lot more easily over the next 2 years, especially if they get that $25,000 a pop model, which I think they're now just combining with the robo taxi concept. Yeah, I will say that in terms of full self-driving, they are not leading. And I don't think or in terms not full self-driving. In terms of self-driving, they are not leading.
Hmm.
Waymo has more miles to intervention. They're running commercial businesses in multiple cities. They are leading. They are the leader in autonomous. Now Tesla's taking um, more of a slow and calculated approach in terms of wanting nationalized regulation. They are going to start to roll out city by city, but I really think they're going to push hard for this federal framework because right now, and when you're whether you're in LA or San Francisco or now Austin, where Waymo's only offering rides through Uber's app now, which is another interesting conversation we can have if you'd like.
Yeah.
That they are leading, and Tesla is catching up.
By the way, this is completely an aside and not important at all, but I saw this hilarious video of like five Waymos trying to get around each other, getting around a Rivian Amazon truck. They were all stuck and like couldn't
Yeah.
go anywhere, and it was just great. It like made my day. Yeah.
And the other thing, like you'll see like people just mess with people in the cars and like stand in front of the Waymo and not get
Yep.
out of the way. It's like that's a little dangerous. I mean, that's you yeah, you can kind of strand someone, which is that yeah, that's yeah, that but I'm sure they'll work on it.
They'll figure it out.
There's so much, yeah, they'll figure it out. They'll
Yeah, yeah,
figure it.
yeah.
Just run them
Um,
over. Just keep in that situation, just run them over.
yeah. Where does Elon fall in the charisma versus deliverability spectrum? Because obviously he delivers, he has delivered, but
Yeah.
like you said, it's not usually on the
Yeah.
timeline that he puts across at first.
I think he's overwhelmingly elite in both regards, in terms of charisma and a tiny bit more elite with charisma, but still equally elite in terms of his ability to deliver. I mean, he has driven, pun intended, the EV revolution. He has spearheaded that and turbocharged it. He is launching like commercial rockets into space and having them re-land on platforms. Like to say he doesn't deliver, I think is probably is probably based on some of his other opinions and people just not liking him because of what they are. But when you ignore all of those opinions, which is what I have to do as a long-term investor and what I have to, and not what I focus on, but his ability to deliver, he is he is world class. He is incredible. And I don't think that anyone evaluating his resume and what he has delivered in terms of product can argue otherwise.
Perfect.
I don't own
And
shares, by the way. I don't, I'm not a fanboy or anything. I criticize him, but he delivers.
yeah, and what do you think about robotaxi and how that plays into Uber? Because you mentioned Uber, and I
Yeah.
want to talk about Waymo Uber as well. But how does robotaxi fit into the equation?
Yeah, I think Uber's going to be total. I own Uber shares, by the way, so a little bit subjective here, for your listeners. But if Tesla owns the entire market, if they're the only general self-driving software in the world, if we think that's the future, then Uber's not going to do well because that network effect, that brings shorter wait times, lower surcharges, more merchants on the platform, all of those things can be emulated by Tesla if they own the entire market. Now, I will say who else should have a gigantic, amazing network effect, probably even better than Tesla, is Google and Waymo. And I mean, they have two Maps products with billions of users, so they have all the algorithm and routing data that they could possibly need. They have seven products with more than 2 billion monthly active users. So I mean, Meta has one with 3 billion and I think four total with over a billion. But so Google's network effect is incredible. So the fact that they are moving to new cities and choosing to integrate exclusively with Uber and exclusively offer rides through that ride hailing service does offer a very, very positive piece of evidence for their perceived value proposition actually being compelling, for their fleet management, their being compelling, and for things like utilization maximization because they represent so much demand, being compelling. And they've talked a lot about that, how these are cash burning, very, very expensive pieces of hardware, and that you can't just build into peak demand right now because that means all other times of the day you're going to have these gigantic cash burn just sitting and doing nothing.
Right.
And what Uber can kind of do in the meantime is bridge that gap and be the complement for drivers so that during non-peak times and we don't have enough capacity, you can use drivers. But at the same time, they can also, once we have this AV world where everyone's driving autonomous cars, assuming that they've maintained that network effect and they've worked with all these companies throughout the bridge, they can maximize utilization for these cars and make sure they're making as much money as possible. Uber can take their cut. They can unfortunately shed a 20-30% take rate that drivers are getting. And the unit economics and margins can still make a lot of sense. That relies on competition. That relies on Amazon and Google and the hundreds and hundreds and hundreds of other startups and the legacy OEMs like GM and Toyota and Hyundai who they're partnering with, or the Chinese competitors like BYD. It relies on all of them failing and Tesla being the only winner and
Mm,
owning the entire market. And in that situation, yes, Uber will fail.
nice.
Yeah.
That's a good explanation. Thank you. I want to pivot a little bit and bring you to Palantir, PLTR, and actually bring you back to May of 2023 and that earnings report. I don't know if you remember it exactly, but from our perspective, how we view the markets, that started kind of this longer term trend. You had an earnings surprise, you had a huge gap up, and it's obviously been a fantastic stock since coming out of a long period where it's underperforming, a lot of years down. From your fundamental perspective, and this one I want to hear your take on, what was the shift there with that earnings report that you think led to now this strong performance in the stock and the company?
Yeah. I think it was the artificial intelligence platform, which for them is just their app and their app building engine for creating custom use cases in the software layer of Gen AI,
Hmm.
for companies to 100,000x drug discovery or to cut energy needs at a pipeline by 30% or so on and so forth. Just creating tangible value with apps that they're building from scratch, not from scratch, but using templates and customizing on top of for their customers.
Right.
I would put Microsoft, Palantir, and ServiceNow. Microsoft and Palantir one and two, ServiceNow a distant third in terms of software companies that have been able to make money and drive the financial needle with Gen AI apps already. Because right now it's Nvidia. It's Nvidia selling a ton of GPUs, and then you see cloud computing growth, but it's really just Amazon and Google and Azure reselling these GPUs and renting out capacity to other companies. You
Hmm.
see Broadcom selling a ton of networking equipment. That's where all the money's being made right now. And that again, that foundational layer has to be set before we have the capacity to ensure that we have high performance computing apps that can scale and work with low latency and do all these wonderful things that we expect them to do in the future. And Palantir really has been first out of the gate in terms of being this pure play software company that's not relying on an Azure to resell GPUs, but is really just creating value building apps with Gen AI, that it's driving fantastic outcomes for its customers. And really, the debate on Gen AI monetization has been return on investment of, if I invest all this money, what are you going to do for me? And really the only tangible piece of evidence for return on investment has been Nvidia saying Amazon and Azure and Google make $4 reselling our GPUs for every dollar in revenue we give to them. So okay, when does this rented capacity turn into software that's going to actually create value? And Palantir has been the only company so far, aside maybe ServiceNow, but they've done so more powerfully outside of the hyperscalers that has been able to pull this off. And I will mention they've done that with using boot camps like as their main go-to-market, like a boot camp meaning basically conventions where they'll host clients and do demos for them and then talk to them afterwards. They're still building an external sales team, which makes U.S. commercial growth, which is where this really shows up in their financial results, all the more amazingly impressive. Not to mention the fact that we've seen, I think, 6 or 7 straight quarters of revenue growth acceleration with margin exploding higher. So it's not like they're spent again not working very hard for this growth. It's not like they're saying, okay, we need to spend way more on marketing so we can grow more quickly. It's we've now built these products, they are now in place, and we are now ready to go sell them with the existing resources we have. And I think the financial inflection that has come from this product has been admirable from them. And I think they've done a better job than pretty much everyone else in their sector.
And where do you put their CEO on the charisma versus deliverability scale? Is
Charisma versus
yeah,
polarization versus
yeah,
deliverability.
yeah, yep.
Uh, I would
You
have
need
put
a
him
5D
on.
metrics. You need
I
to
would
rate
have,
his
I
hair
would
as
have,
well.
I would have skewed the sophisticated calculation towards charisma up until about a year ago. But he has really delivered over the last year in all of these sensationalistic, intellectually crazy sounding things that he has said are starting to be backed up by their results being fantastic.
Hmm.
I will
Cool.
also say the valuation is crazy, but the valuation is crazy. The company is thriving, and basically the valuation at this point in time is bulls relying on the fact that profit growth and revenue growth is going to be far in excess of expectations right now. And that has been the case for over a year, but it needs to continue to be the case for this to keep working, in my opinion.
Gotcha. And you mentioned Nvidia. What's your take on its move and kind of the longer term prospects as well? Obviously, it's been a huge driver and profiter from the AI and all that, but where does it kind of go from here? What do you think?
Yeah, I am in the camp that the foundational Gen AI layer, sorry, I've probably used that term too many times, is that monetization boom is not starting to slow down, starting to stabilize, I would say. And really it's in two pieces of that NVIDIA quarter that we saw. One is their forward guidance being a lot closer to expectations than we've seen in 8 quarters. I mean, they've just it's their fault. It's their fault that they've trained everyone to expect such amazing, incredible,
Yep.
outstanding results. Like Jensen's just too good at his job. It's his fault. But then they deliver a 1 or 2% outperformance on a guide last quarter, and it's completely shrugged off, and that makes sense because when you train Wall Street analysts to be so wrong about their forecasts for 2 years, they get a little more aggressive and they round everything up a little bit more, and they try to get in front of that. And I think it being so close to the sell side number tells them that they don't have to play this catch up game as much anymore. That they've gotten a feel for this Gen AI boom, this Gen AI demand, and the explosive upside in excess of assumptions is probably in the rear view at this point, I think. And we heard Nvidia. I thought this was very interesting commentary on the call. Jensen Huang talk about we have several quarters of supply constraints for the new Blackwell chips, the new GPUs that are flying off the shelves. But
Yep.
several quarters gets us into next summer, and they've been talking about several years of just excess or supply scarcity driving crazy pricing power and crazy orders, and we can sell everything we can make for as much money as we want to. And I think that runway, maybe I'm reading too much into the wording here, but it sounded like it shrank a little bit and sounded like supply demand equilibrium is going to become more in balance throughout next year. And maybe that's AMD making performance gains. Maybe that's Amazon or Apple making performance gains. I really don't think so because AMD talks about getting to Hopper level. Or I'll try to minimize the number of terms I'm using, but get to Blackwell level performance by the time that NVIDIA is already going to be rolling out their next platform called Rubin with a more explosive performance gain. So no one's catching
Right.
them. I just think that the sense of urgency, the catch up from all these hyperscalers and other companies to buy as much as we possibly can and to figure it out later is starting to slow down just a little bit.
Interesting. And a more general question based on what you just said, when you're listening to an earnings call, and I understand it's definitely very company dependent, the metrics you're listening for, the key commentary you're listening for, but when you're listening to an earnings call, what are you doing to make sure you're assessing and paying attention to the key things that investors and the market's looking for? How do you like to organize your thoughts to make sure you're paying attention to everything that's really, essential?
Yeah, it's just it all goes back to, and I think Spotify does such a great job of conveying this, and I'm pretty much stealing their idea, but of creating more value than we charge for. It's where are you showing me signs of you're creating unique value for your customers, you're creating unique shareholder value. And sometimes that shows up in something like transaction margin for PayPal, which is the same thing as it's basically its gross margin expanding because you have more pricing power, because you're selling more of your software, because you're creating more unique value. Sometimes it shows up in things like Lemonade's loss adjusted expense rate, which is basically how much are you paying to handle or claims from your customer, your insurance claims from customers. It's lower than everyone else that's 100x bigger than them, despite having far lower economies of scale. And that is something that creates durable value that should be focused on because it can allow them to do things like undercut on car insurance premiums in the future and take more market share.
Hmm.
So it's just it's putting together this puzzle of value creation for every single company. Are the ingredients in place that you can give your gigantic enterprise customers? Maybe you're selling to Amazon, maybe you're selling to me, and I'm spending $50 with you. Regardless of that, are you giving me more value than I can get from the other guy offering you a similar product? And it is obsessing over every single piece that goes into that decision for every company that I follow, and making sure that I cover that in the earnings call. But it is so different for every company, so I have to give that annoying answer, unfortunately.
No, I mean, this is never boring. That's
Okay.
this is this problem we have of finding the best companies, noticing, the key things. That's what keeps this very interesting and keeps us
Right.
engaged. So, and Brad, another recent IPO that has been pretty interesting for our style and also just been, a great company and growth story is Kava. I'd love to hear your thoughts on that, kind of where it is now, where it was a few months ago before it's had this nice move, and your perspective on the business. That'd be great.
Yeah, I think this is a case of where TA beat FA for sure. You got like the chart has been I'm assuming the chart has been really pretty since the IPO. Yeah. Kind of hard not to be when it's when it's up and to the right, but um, the valuation was stretched when it IPO'd. I mean,
Hmm.
and now it sells for $50 million per restaurant location, which is just insane, absolutely insane. It cost them, I think, like $2 million to build a new Kava. So basically, they're saying we're building at 25x valuation, which is just it's not sustainable. But that doesn't mean the company has to go down 50%. It means that it means the stock can chop around for a year or two and grow into its shoes and then kind of go from there.
Right.
And I think with a company like this, honestly, that's somewhat realistic. And I haven't been able to get comfortable enough with evaluation to even buy a small piece of it just because it is so over the top. I mean, it makes Snowflake and Palantir look cheap. That's how expensive it is. But I wrote a deep dive on this when it was IPOing, and the team is phenomenal. Brett Schulman is right there with Chipotle and now Starbucks is Brian Niccol in terms of being elite food service CEO. I mean, you look at their microservices architecture and how they rebuilt their entire ecosystem, their digital ecosystem from the ground up to a point where now they can stand up a new loyalty program in rapid time, or now they can update their app constantly and split test with ferocious velocity like you'd expect from a software company.
Hmm.
Or they can implement AI video monitoring in their stores so that they can nudge employees to replenish ingredients more quickly and offer better service. Just things like that where you're like, are you a tech company or are you a kava company, a Mediterranean bowl company?
Yep.
And and I like saying that because they don't say that on their earnings call. They don't call themselves a tech and AI company. They say we're a restaurant company and we sell great food and we have a great human connection. But where we can, we're using tech and AI to make things a little bit better. And to me, that's what food service investors want to hear. They don't want to hear that we're getting rid of all the people and robots and it's all AI. Like there has to be some kind of human element to it. But
Yeah.
all this kind of manifests in when they say they're gonna release something in September, it gets released in June. They're 3 months early with everything. They beat and raise guidance every single quarter. They raise their same store sales guidance from like high single digits to low double digits, which is insane as their competition struggles to maintain positive traffic right now. And that's not being driven by price hikes. It's being driven by the fact that their traffic is going through the roof that much. Just one more anecdote to tell you how crazily successful this business has been. Last quarter, they talked about how they had to slash marketing expenses in Chicago because their stores were too busy and their employees were getting overwhelmed, and they had to create less attention at the store, which is just what? I mean, what do you that doesn't make any sense. But I mean, it's just bonkers. So it's a point of elite company that's probably going to trade at a premium valuation for a very long time. But at some point, you got to look at it and say that that's just too much. And to shareholders' credit, I was saying that 50% ago, and now the stock's at like $160. But it's another one of those things where I can't chase, have to be disciplined, stick to my beliefs, and understand the fact that I'm going to be wrong sometimes, and I'm not going to invest in every single company that's going higher. But great company, pretty good food too.
I like Chipotle better personally, but
I do too.
I like both stocks.
I-
So Kava, it's a great example. This is from a TA perspective. So I don't know if this will be too interesting, but from a TA perspective, it fits a template of new IPOs of great companies that end up being massive winners over the long term, where you get an initial move up, initial hype, it consolidates, pulls back, 30, 40, 50%, whatever it is, and
nasty.
then that it forms a base, kind of goes nowhere, and then from that move is kind of where us as technical traders would be interested in a longer term move that might kind
Yeah,
of fit your time frame and style. We saw this, CrowdStrike was an example. Zoom obviously was accelerated by COVID and everything, but it was coming out of
Duolingo.
that.
Yeah,
Yeah, Duolingo, exactly. So um, if I was a much longer term trader or investor, I'd be really focused always on that template of recent IPOs that had hype. They've got phenomenal teams. just kind of the growth is, the valuation's a little stretch at the IPO, they consolidate for a bit, and then I'd be looking for that turn. So that might be something
Yeah,
interesting for you to pair the TA perspective with your fundamental perspective
for sure.
of looking into those companies.
Absolutely. Good perspective.
Yeah. And you mentioned with Kava the human element that they stress that. Is that something that Starbucks is trying to bring back? I kind of heard some things
Yeah.
about they're going to write your name back on the cup and
Yeah.
they're trying to become your local coffee shop again. It's
Yeah.
interesting. Yeah, yeah. I'd love to hear your thoughts on that.
No, it's no, it's I think everything that the you heard Brian Nichols' opening remarks, and you could have summarized it by saying everything the old team was doing, we are reversing every single decision. And it's from getting the Sharpies back for the Q barista to write the heart on your cup that makes you excited and happy throughout the day. That's going to make you come back every single day for the next year. From making sure baristas are handing you your beverages now, so there's not this clutter on an end table next to the bar with 50 cold drinks
Yep.
of and people yelling out names and just not a really not a great experience. They're bringing back the condiments bar so that people can actually add milk and cream and sugar to their coffee if they want to. They're doing things like yeah, human element. One other thing that I'll talk about, and it's why Kava is so successful, and it's why I think Starbucks is going to become so much more successful, is this stage gate process to food-based innovation of rolling it out in a very slow, data-driven way, of rolling it out to 5 stores and taking your time with observing how did people react to that. Do they have any feedback? Is there an ingredient that we can change a little bit to make it more appealing to them? Let's roll it out to another 5 stores. Let's roll it out to another 10. Let's go so slowly that by the time we roll this out nationally, we painstakingly know that this is going to work. And juxtapose that with the old Starbucks team, and Brian Nichols said this in his first earnings call about how there were processes, stage gate processes in place to discipline introductions of new food and drink items. And while those were in place, the old team just kind of ignored them and rushed things out and did their own thing. So they had all this data, they had all these processes, they had all this plumbing in place, and they said, nah, we're gonna guess, and we think this blueberry muffin tastes really good. So that means the entire world's gonna think this blueberry muffin tastes really good. And that's actually how they behaved, which is just negligence, a nice way of putting it. But yeah, I think between Kava and Starbucks, it's that it's marrying that automation with still giving you that human feel that we all kind of yearn for when we're going out for to be served coffee or food.
And that data drivenness is kind of similar to what we talked about with Duolingo, where they're analyzing every aspect, being very, letting the data drive their decisions and improvements. So that's pretty interesting. Yeah.
Absolutely. Observe, don't or react, don't predict. Like I think that's yeah, that's the way to be.
Yeah. Of the other companies that you cover regularly, which I know there's like 5,000 that you cover regularly every single earnings cycle, are there any that come to mind that represent a really good example of what you look for as a fundamental investor, or represent a good lesson that you learned personally, or otherwise might be interesting to our audience, which are more trader focused, and things they can up on as beginner fundamentalists
Yeah.
to improve the process.
Um, I'll go back to SoFi, I think.
Yep.
And I think it's just a bank. It's like it operates in a commodity, so it's just thinking through these ideas of where is it creating incremental efficiency where others can't, and that's you can do that, I can do that, we can all do that. It's just it's just thinking through basic ideas of man, they don't have any branches. That's got to be really cheap, and they can operate a national bank without having branches. That's going to save a lot of costs and no tellers, and how much money can they pass on to customers because of that? And man, they own their entire API-based tech stack, which means they're not paying any third-party vendors fees at all.
Right.
Like all of their competition is, and they're turning this into a revenue stream by generating more profit with through their Galileo product. So it's just it's really thinking about where is this unique value capable of being delivered, and how capable are they of delivering it for a very long period of time? How defensible is it? And that really shows up in things like financial statements, which is if you have an incredible value proposition that you tell me amazing things about all the time and your financials have sucked for 3 years, you're probably wrong, or you probably need to fix go to market, which still means you're wrong in a different way. But for SoFi, um, it did show up in financial statements. So while you had 3 years of banking analysts and gray-haired people who don't say gray-haired people, Brad. Well, you had banking analysts and incumbent analysts who have been trained here to know what things should look like, and they're seeing this very loud disruptor doing things a different way,
Right.
maybe they're going to be a little hesitant to embrace them. And maybe the mean ones are going to call you an idiot on social media for thinking that there's something here, that you definitely think that this can bounce back when macro cooperates a little bit. Maybe entirely kosher gap fair value accounting that they're calling the most evil thing ever. Maybe they have some kind of incentive or some kind of subjective opinion that's skewing their point of view. So it's really just trusting that the signal that we can all glean is in financial statements and in what management is telling us. Making sure we're keeping that filter in our heads so that we know we're not letting them bullshit us if they're being overly charismatic or unfair. But it is all there. And then the conversations with bears and with skeptics are extremely valuable to a certain degree. And at some point, they become very noisy. And you've heard all of this, and you don't need to respond for a fifth time with the exact same argument. And you need to put the phone down and put it somewhere else and go read a 10K, or if you don't have any work to do, go play around a golf. Because again, stomach is the most important thing for making money in the stock market.
Yep.
And that is hurting your probability of being disciplined and staying the course and overcoming the noise after you've already done all of the work to know that what matters, what's important is going well for the company. So if that's true, stick to your laurels because you can be wrong for a certain period of time, but you cannot be wrong. Like you will not be wrong forever. You will be rewarded eventually as long as the ingredients creating that unique value proposition that manifest in fast profit and revenue growth. If that happens, multiples can only contract for so long before they explode higher.
Perfect. And obviously 2023, 2024 has been a pretty good year for investors in the markets. But I do want to bring us back to a less happy time, 2022, which you mentioned earlier, um, and kind of talk through your perspective on that, what that taught you about staying the course, and also, any, key lessons learned from a pretty significant bear market that we had that year.
Yeah, and in hindsight bias, but I would talk to the communities that I talk to and say things are too stretched, things are too expensive, it's getting irrational, and then I'd trim 10% of a position. And it's like, well, listen to yourself, man. Like listen to yourself. Things are stretched, things are ridiculous, things are irrational. It's okay to build a bit of a cash position sometimes. It's okay not to be fully invested all the time. And I really think that getting through that one of the sharpest, quickest, most aggressive macro cycles we've ever had is going to be for me and for you extremely valuable for the next decades of our life. Like I feel like we got a history book lesson in 20 months in like 24 months. I feel like we got a generation of macro education in like 2 years. So yeah, I'm being a doofus and don't
No,
remember what the question
yeah,
was.
yeah. It was about 2022 and kind
Right.
of what that taught you, what you look to improve based on that experience, all of that. And
Yeah.
I completely agree with you that the it's been crazy the microcosm of events we've had in the past. Like, I've been trading. First started the end of 2018. Since then, we've had
Yeah.
Fed cycles. We had COVID. We had bear market. Like it's been a great time to learn because there's been
Yeah.
so many different things that can happen. But yeah, I'll
For
pass it on to you.
everything that has been able to happen has happened in the last few
Yep.
years and then some. But I think it's just really getting back to that for a long-term investor and for you guys. I know there are different things that you have to weigh and that's totally fair. But it's getting back to this balance of yeah, can't get complacent, can't need to be fearful when others are greedy, as the famous Warren Buffett always says. But and while I can't let a lemonade go from 6 times gross profit to 18 times gross profit in a month and not take some profit off of the table and not right size, you just have to respect the fact that that's still very fresh on our minds and that none of the macro ingredients in place right now resemble what they did in 2022. Like, we're not
Right.
going to have 20 rate hike. We're not going to have 20 rate hikes. We're not going to have aggressive ramping quantitative tightening from the Federal Reserve, which is another very restrictive policy that they had in place that is now kind of probably going to start to wind down hopefully in the coming quarters. Again, CPI is below 3%. It's not above 8%. And also again, we've gotten that needed multiple contraction from all these companies. 40 times sales is no longer a conversation of reasonable or not reasonable. If you go on X after Nvidia's earnings report, the intense heated debate is 40 times earnings deserved or is it not deserved when this company is posting 40% year-over-year earnings growth, so 1x PEG
Yeah.
ratio divided by 40. So that's way healthier. The conversations we're having today versus 2 years ago are leaps and bounds healthier, and more sane than they were. So it's again balancing the fact that I cannot let things endlessly race higher. There are pockets of froth. There has been aggressive multiple expansion some places, but in other places, things still look really, really reasonable. And I need to let things run a little bit and not be so quick to not let myself be right. So it is respecting 2022. It's respecting the taper tantrum in 2018. It's respecting every single market tantrum we've had
Yep.
over the last 100+ years, over the next 100+ years, but also letting ourselves take advantage of the fact that it's been up and to the right for the S&P 500 since 18 whatever, since that chart starts, 1890 something whatever. But yeah, it is balance. So it is threading the needle with a non-answer basically.
No, I think that's valuable. And another question I want to ask you, and I think this is really interesting. I asked this to traders as well, so don't feel special, Brad. But how do you define risk? And from a trader perspective, risk is controlled by position sizing, where our
Yeah.
stop loss point is based on whatever setup we're using. From what I've kind of observed from you, and I want to hear your real answer, risk is managed through position size for sure, but also the deliberateness of decisions and speed at which you take decisions. You're very deliberate over time. It's very process oriented. But yeah, I want to hear your answer. How do you define risk, and how do you apply that as you take action in the market?
Yeah, so I love using the PEG ratio framework for defining risk just because I don't think it's fair to say a company trading at 150 times earnings versus a company trading at 100 times earnings is necessarily more expensive if their profit growth is going to be double what theirs is over the next 3 years. So it's combining skin in the game. So that has to be part of the conversation. And candidly, when I saw Lemonade go from 3% of holdings to 8% of holdings and became my second largest position, it was like, geez, that's very uncomfortable. And when you combine that with the aggressive spike higher in its gross profit multiple, it was like, yeah, it's time to trim. But I think it's position sizing. So that's one piece of the puzzle. It's PEG ratio and then it's execution. So if you are a Duolingo and you're delivering 20% upside to profit forecast every single quarter and then giving me even larger upside on the raise for next quarter, I can let 1.1x PEG ratio is less risky for you than it is for SMCI, for example, of a company I don't own and have never owned it. I feel like I need to say that. But I feel for the people who do because I have been burned by dishonest, shady people in the past, or CEOs in the past, and it gets all of us, and it sucks. And I'm sorry. But so position size, PEG ratio, and then execution. So quality of company, like a Visa, we'll trade it at 2x PEG ratio, and you can't look at that and go, that's crazy compared to a company, even like a company like Duolingo that's at a 1.2 or 1.3, because Visa has 20, 30, 40 years of compounding data, not 40 years. Visa has a couple
Yeah.
decades of compounding data that is just made it painstakingly obvious that it is one of the highest quality companies in the world. And so you're willing to pay more for that future growth because it's so certain. And with a company like a Duolingo or somebody else that's been around for a few years and it's or big for a few years, I should say, because Duolingo's been around for a while. That certainty is lower. So the PEG framework idea is slightly different and there's this slightly more nuance. It's if there's one takeaway that I think the listener should have from all of this, it's that we all have our processes and we all have our rules, but this is very much so an art and a feel. There's a very much so an art and feel based aspect to this as well. Of me seeing Lemonade go from 3% to 8% of a portfolio and thinking I know next time we have a macro data point where okay, well now rate cut probabilities are slightly lower for next month. I know it's going to be the first to get punished in that scenario. So yeah.
No, that's great. And um, having touched on 2022, have you considered, and obviously this is just a consideration, just a kind of thought question. Have you considered implementing some type of hedging strategy as well to try to dampen
Yeah,
bear market corrections like that? I don't know if you've thought about that at all. I'd just love to hear kind of your perspective as an investor on potentially
definitely.
hedging. Yeah.
Yeah, so I'm 27, so candidly, portfolio is not large enough to be doing to be selling options as aggressively as I'd like to be around earnings when I think when I'm having these feelings of, well, maybe people are too excited and so what I'll do, which is less ideal to me than selling calls, is I'll purchase disaster insurance or way out of the money puts, and just in case they screw up and, oh man, I was wrong and everyone is deciding this is a zero now. We'll be a little less damaged in a little more okay in terms of that day's underperformance versus benchmarks and overall. But in terms of risk management, a lot of the risk management that I'm practicing is trimming a company when the multiples explode higher and when
Mhm.
it's when risk reward is deteriorating. My hedging practice is just taking profit and taking some off the table. But for I do, and I do this sparingly, but sometimes I will purchase out of the money puts into an earnings report only for a company that I already own. I'm not purchasing them in a naked fashion or however
Right.
you TA guys say it. But yeah, I'll do that and then just right sizing position. But no stop. I don't do stop losses. Yeah.
No, no, that's perfect.
I know there's a
And
question from a Twitter guy in there, but I think for you guys, stop losses are a no-brainer, and for me, it creates too much portfolio churn when I want to be taking advantage of this volatility and not shying away from it most of the time.
for sure, it's an essential part of our trading style versus for
Absolutely,
investing, completely different games.
100%.
And speaking as somebody, I'm 26, you're 27. This is a more general question here. Do you have any kind of thoughts on general financial literacy practices that people should follow before getting really involved and serious with investing, or just kind of recommendations of things you wish you learned when you first started getting into this as a 20-year-old? Because I think there probably a lot of 20-year-olds watching this who might just be getting started and kind of want to hear that guidance.
I think it's, and I'm the millionth person to say this, but I think it is such a shame that micro and macroeconomics are not part of core high school curriculum for all US students. Because I think learning financial statements and learning how to read financial statements and understanding Fed cycles and cost of money are just two of the most important things that we can do for building financial health and for building prosperity and for being a happy person that can, well, money doesn't buy happiness, but it kind of helps. It does definitely help. But being a person who can go on a vacation with their family or buy that house that they want, it's so unbelievably important. And the frustrating thing is that K-12 doesn't teach it right now. I went to private school and it was an elective that you had to seek out yourself.
Right.
But the exciting thing is that there are Harvard classes online or YouTube tutorials from great creators like Richard who will teach all these concepts from FA to TA from stage analysis to you for free, and they will walk you through in a very simplistic way. Um, think Brian Froley does a good job of this on YouTube.
For sure.
Just very high level, 30,000 foot view financial statement concepts that I think are just so important to master. And fortunately for all of us, just arithmetic. Like if we can all do this math. As soon as you learn the acronyms and the lingo, you will look up and go, dang, this was so much easier than I thought it was. So yeah, I think that's really important to learn and fortunately not super hard to learn.
Yeah, it would be so awesome if K through 12 provided, not just about reading statements, but in my view, how to analyze a loan that you might receive, or compound
Yeah,
interest, get more
cash
on
flows.
that.
Yeah.
Yeah, I think there's so many things that yeah, that we aren't properly prepared for. But um, yeah, Brad, this has been fantastic. I've learned a ton, and I think like I said at the very beginning, there's a completely different perspective, but there's so many complementary principles and key takeaways that traders can take away from this, investors can take away. So this has been great. Do you have any kind of general motivating words for new investors, people watching
Yeah.
this? Any advice for traders who want to learn more about fundamental analysis? You might mention a resource that you'd recommend. Yeah, any kind of last final words?
Well, obviously the resource is my newsletter. Like that's the only that's the only good fundamental. But what I think really what I want to leave everyone with is that, Richard and people from the stage analysis process, day traders, macro traders, special event people, every one of those processes has people in it that are wildly successful. And there's no because I do things one way and he does things another way. I don't think that I think it's extremely valuable to learn from each other. I think it's extremely valuable to combine knowledge where we can and to collect insight.
Yeah.
And I think it's extremely damaging to say, well, I do FA, so charts are stupid, or I do TA, so fundamental analysis is stupid. I think that's just that intentionally limiting our knowledge base, and I don't think that's right. And at the same time, however your personality works, I mean, this is what we pick is a function of who we are as people. So my personality ticks in a way that makes me gravitate to FA. Richard's personality ticks in a way that makes him gravitate to stage analysis. And whatever that is for you is what you should be pursuing. You should not be trying to fit a square hole in a round peg. You should be doing what speaks to you. So
Yeah, perfect. I kind of view it as like with companies, it's a different business model. This business model works for me. You have your business model that works for you, and if different business models can be very, very successful, you just have to find the right one that fits for that company and all that. So,
yeah.
and I did want to mention, where can people go to learn more from you? I'll have the link to your Twitter down below, your newsletter as well. Anything you'd like to say about Stock Market Nerd? I think everybody watching up to this point is a stock market nerd, so I think it's an easy sell. But yeah, where can people learn more from you if they'd like to, Brad?
Yeah, stockmarketnerd.com is the newsletter. The first few sections of every article are always free. So people can get a sense of if they find the content valuable and if they want more of it. And hopefully they do. And if not, totally understood. It's not for everyone, but that is where the library of so much content. Yeah, man, I looked back at how much I've written over the last 4 years and almost started crying because like, geez, I don't know. But not actually. That was a joke for the crowd for that for clarification. But yeah, stockmarketnerd.com is where I do all my writing. I surface level stuff on Twitter, but that's really used as top of funnel marketing for that newsletter. Yeah,
Perfect. Yeah, we'll have the link to that down below in the description as well.
thank you.
Brad, again, thank you so much for your time. I really enjoyed this. I'm going to watch it back, take some notes. To everybody watching, I hope you enjoyed it as well. Leave a like down below. Subscribe to the channel if you're new, especially if you're one of Brad's fans and this is the first interview you're watching.
Yeah,
We've got a lot of great other great interviews that appeal to also the investor side. We've had Brian Feraldi on. We try to have a wide range of styles on here
yeah.
that
Can I
you can learn
interrupt
from.
you?
Please.
So if you are listening to this because you know who I am and don't know who Richard is as well, which is probably a very, very small minority of this recording, he is, if you ask me who should I follow for stage analysis, who should I listen to for this type of information, it is a very quick answer and it is him. Like lot of respect for Richard, a lot of respect for what he's doing. And I don't say that about very many people who I interact with on Twitter.
Well, that's kind. Thank you very much, Brad. So listen to Brad, subscribe. But yeah, thanks so much, everybody. I really hope you guys found this fun, valuable as well. Check out Brad's resources down below, and we'll see you guys in future videos. Take care. Bye.